Hello guys, welcome to the video. Price action is a way of trading by looking at the market's movement. No fancy indicators, just the price, trends, and key levels. It helps traders spot good trade opportunities. In this video, I'll show you some of the most interesting trade entries using price action. Make sure to watch till the end, and don't forget to like and subscribe. Let's get started. Let's start with market structure and key levels. Key levels are important price points where the market often changes direction. When the price moves up before sharply dropping, it creates a resistance level. Resistance is a level where the price struggles to go higher and instead falls back down. When the price returns to this resistance level, it can be a good place to sell, leading to a potential short trade. Why does this happen? When the price reaches a known resistance, it is considered too high and fewer traders want to buy, leading to a drop. Now, looking at the opposite side, when the price moves down before sharply rising, it creates a support level. Support is a level where the price struggles to go lower and instead bounces back up. When the price returns to this support level, it can be a good place to buy, leading to a potential long trade. Why does this happen? When the price reaches a known support, it is considered too low, and more traders step in to buy, pushing the price up. Understanding support and resistance helps traders find good entry points for buying and selling. Now the second signal is double top and double bottom pattern. A double top or double bottom is a popular reversal pattern that traders use to spot potential market reversals. A double top forms when the price fails to make a new higher high, which could be due to a loss of momentum, a shift in market structure, or reaching a key resistance level. The most conservative way to trade this pattern is to wait for the price to break below the neckline to confirm the reversal. However, entering after the neckline break can lead to a larger stop loss. A common approach is to wait for the price to pull back to the neckline and look for candlestick rejections to enter the trade. But if there's no good rejection, the opportunity might be missed. To improve trade entries, the Fibonacci retracement tool can be used. After the neckline is broken, the tool is applied from the start to the end of the move. A sell limit order is then placed at the 61.8% retracement level for a better entry. Since market moves aren't always predictable, the retracement tool should be adjusted if price moves deeper before pulling back. If the price doesn't pull back and reaches the target, there's no need to enter the trade anymore. The same applies to a bearish scenario. If the price rejects a level twice and breaks below the neckline, the Fibonacci retracement tool can be used to find an entry at the 61.8% retracement level. The stop loss is set above the previous swing high, and the target is the next level of market structure. Not every double top or bottom is a strong setup. The best approach is to identify key levels on higher time frames where price has rejected multiple times. Then, wait for a double top or bottom to form on a lower time frame. This can also be combined with smart money concepts. For example, if a demand zone is also an order block or fair value gap on a higher time frame and price forms a double bottom there, it can be a strong reason to go long. Combining price action patterns with smart money concepts helps in making more precise entries. Now, the third signal in price action trading is trendline bounces and breaks. First, what is the difference between trendline bounces and breaks? Trendline bounces happen when price touches the trendline and moves up, meaning buyers are still in control. Trendline breaks happen when price falls below the trendline, meaning the uptrend might be weakening or reversing. In an uptrend, the price moves higher, making higher lows. We draw a trend line by connecting these lows. When the price comes back to touch the trend line and bounces up, it means buyers are still strong and the uptrend may continue. A trend line break happens when the price falls below the trend line and closes under it. This shows that buyers are losing strength and the market may be reversing or entering a downtrend. Some traders wait for a retest, where price comes back to touch the broken trend line from below before confirming a sell entry. Now, let's move to the four signals. The engulfing candle. An engulfing candle is a two-candle pattern that signals a trend reversal. A bullish engulfing pattern appears in a downtrend. A large candle fully covers the previous candle, showing buyers taking control. A bearish engulfing pattern appears in an uptrend. A large candle fully covers the previous candle, showing sellers taking over. You can use a bullish engulfing candle to spot a possible trend reversal. If the market is in a downtrend and a big candle fully covers the previous candle, it signals that buyers are stepping in. This often leads to the price moving up, creating chances to buy. A bullish engulfing candle can also confirm a trend continuation. If the market is already going up and then forms another bullish engulfing candle, it shows that buyers are still strong. This means the price is likely to keep rising, giving more buying opportunities. A bearish engulfing candle works the opposite way. If the market is in an uptrend and a big candle fully covers the previous candle, it signals that sellers are taking control. This can cause the price to drop, creating chances to sell. You can also use a bearish engulfing candle to confirm a trend continuation. If the market is in a downtrend, sometimes the price pulls back before continuing lower. When a big red bearish engulfing candle forms after a pullback, it signals that sellers are back in control. This often leads to more price drops, creating more selling opportunities. Now, the 5 price action signal is the inside bar pattern. In a bullish inside bar pattern, a large candle appears first, showing strong buying pressure. The next candle is smaller and stays within the range of the first candle. This means buyers are pausing, but sellers are not strong enough to push the price down further. If the price moves above the high of the larger candle, it confirms that buyers are back in control and the market is likely to continue upward. In a bearish inside bar pattern, a large candle forms first, showing strong selling pressure. The next candle is smaller and stays within the range of the first candle. This means sellers are slowing down, but buyers are not strong enough to take control. If the price moves below the low of the larger candle, it confirms that sellers are still in control and the market is likely to keep moving downward. Here is an example. When the price breaks a key resistance or support level, traders look for confirmation to ensure the breakout is real. One way to confirm this is through the inside bar pattern. After a breakout, an inside bar forms when a candlestick stays within the high and low of the previous candle, showing temporary indecision in the market. If the price then breaks above the high of the large candle, it means sellers tried to push the price back inside the range but failed. This confirms that buyers are in control, increasing the chance of the price continuing upward. That's it for this breakdown. If you found this helpful, make sure to like, comment, and subscribe for more trading insights. Stay sharp, trade smart, and I'll catch you in the next one. Peace.